Over 90% of the people are trying to beat the market, and that includes pros as well, and they fail every single time. 9 out of 10 investors get worse return than if they would have just taken the money and invested in S&P 500 index fund and walked away. The reason why, because not that you're unlucky, it's not that because you're not smart, but it is because that you're playing that game completely wrong. Now, if you're a busy professional like myself with a strong career, the world of investing may feel like a second job where you didn't ask for it, but you have to do it. Every day, it's a new hot stock or a new prediction of the market crash or a new crypto that is going to change everything, and you're kind of gravitating towards it. It is designed to be overwhelming, but you don't have the time to do the full-time analysis of what it takes, only the 1% that actually make it work in the day trading. The good news is you don't have to be that. The tiny group of investors who build real wealth in today's age, they're not gurus. They don't have a crystal ball. They just use different framework. And this video, I'm going to give you 3 simple part plan to build your wealth without the stress that it comes from investing. This is not about a get quick rich scheme. It's about becoming wealthy for sure. The first step is the most important one. You need a total mindset shift. Most of the people, they think that investing is a battle against the market. They think that if they just become a little smarter, they'll start to win. But that's not true. That's actually wrong. The real opponent is not the market. It's you. Benjamin Graham, the man that Warren Buffett said wrote by far the best book on investing ever. But his entire philosophy is one simple idea: mastering your emotions. Now, to help, he invented a character in his book that he called Mr. Market. Imagine that you have a business partner, Mr. Market, and every day he shows up and offers you to buy your shares or sell you his shares at a price. But here's the catch. Mr. Market is emotionally unstable. Some days he's going to be euphoric and offer you insanely high prices. On the other days, he is terrified, he's scared, and he will sell you shares for almost nothing. The losing investor lets Mr. Market decide how they want to feel that day. When he's happy, they get greedy and buy it at the top. When he is panicking, they get scared and they sell at the bottom. The smart investor does exact opposite. They see Mr. Market as not as a guide, but as an opportunity. They sell to him when he's euphoric and they buy from him when he is in a panic mode. So your job is not to predict his mood. Your job is to know the real value of what you own and act only when the price is at a great deal, which is majority of time in market crashes. This means that you have to ignore the daily noise. It means that the market crash is not a disaster, it is actually things on sale. This one mental flip is what separates the winners from everybody else. A great mindset is crucial, but if you're a busy professional, you cannot just wait around to find out if the market is good or market is in a panic mode. Your real enemy is not the crash, it's the decision fatigue. It is the constant draining pressure to do something and take that action. But the solution here is not that you need to become stronger at willpower. It's actually a better system. Complexity is going to deter you from taking action because the wealthiest investors, especially those who have demanding jobs and career, have incredibly simple financial lives because they have automated things to do what matters most. The core of the system is what I call the pay yourself first. And you do this with automatic transfer. So here's the setup. The day you get paid, fixed amount of money automatically goes from your checking account into your brokerage, your trade investment account. So you decide a one-time setup and you set it up and you are done. Just like very much the 401k, which takes away from your paycheck and automatically gets invested in your 401k account. This simple action is your superpower. First, it removes the emotional effort from the process. You're no longer asking, is this a good time to invest? The decision is already made for you. Second, it makes investing non-negotiable expense, just like you have other your expenses like your rent. You invest first and live on the rest. Third, it guarantees you the strategy is called dollar cost averaging. And when you invest a fixed amount regularly, you automatically buy more shares when the prices are lower and fewer, or when they higher, you don't buy much. You're buying low even without thinking about it. This automated system is your defense against your own worst instincts, your emotions. It ensures that you're always in the game, and that automated discipline is infinitely more powerful than trying to perfectly timing the market every single time. Okay, so now you say, okay, now I have the mindset. You have the system. The final part is the strategy. This is where majority of the people get lost because they think that they need to find the next Tesla or SpaceX to build the wealth. Well, that's one of the biggest myths out there. Chasing unicorn stocks is not investing. It's actually speculating. The smart investor strategy is to build another of Graham's ideas, the margin of safety. This means you buy an asset when its price is far below its real value. Now, for busy people, the ultimate margin of safety is not stock picking. It's actually radical diversification. Instead of trying that one needle in the haystack, you buy pretty much the haystack itself. The easiest way to do that is to do with low-cost index funds like ETFs. And S&P 500 index funds give you a small piece of the 500 largest US companies. A total stock market funds gives you the piece of almost all the public company that is available in the US. This strategy wins for two reasons. First, the diversification protects you if one company gets impacted or goes out of the business, or even an entire industry fails. Second, the fees are very low, and actively managed funds charge high fees that eat away your return. And the data shows that because of those fees, the vast majority of the fund managers fail to beat even a simple index funds that is tracking something like an S&P 500. By choosing and accepting the market's average return, you're statistically setting yourself up to beat majority of the pros. And it feels like settling, but it's a very brilliant strategy, and you're trading the tiny chance of speculating win for near certainty of building wealth over the long term. So for a busy professional, that's the smartest trade that you can make every single time you get paid. Now let's make this real. Meet Alex. Alex is a project manager in a tech company, and he receives a lot of compensation in RSUs, which is restricted stock units. And what Alex does is one mistake. Alex's company stock is soaring. Now Alex, feeling brilliant, he holds it all vested RSUs, or may even buy more of those because he feels that the company is doing really well. Now Alex's salary and net worth are completely tied to one company in this case. This is not investing. This is a high stakes bet on one specific possible unicorn. Now let's see how the smart version of Alex uses this framework. First is the mindset. Alex sees the soaring prices through the eyes of Mr. Market. Now, in euphoric, high-priced market stock is riskier. It's actually not safer. The time to be excited about the great company is when it's cheap and when it's on sale. Second, the system. Now, Alex creates an automatic rule. Every time the RSU vest, sells 50% immediately. So he's not selling the entire portfolio because he may be getting upside of the stock as well. And there's no emotion involved. The cash is then automatically invested into a diversified portfolio of low-cost index funds. This process is completely automatic. Third is the strategy. Now, Alex needs a margin of safety. Having your job, your life savings tied to one company is risky. The strategy is to systematically turn that single high-risk stock into a tiny piece of companies that is covering a large portfolio. Notice the trade-off here? By selling, Alex misses another 20% gain, but in the exchange, Alex removes the risk of being financially destroyed if that one company fails. A 50% drop in one stock requires a 100% gain just to get back into the break-even territory. The smart investor trades the thrill of what if for the confidence of no matter what. So getting to the top 10% of the investment does not require a secret algorithm or some type of a insider knowledge. It just means that you have to play the game differently. It's a game that you master your own behavior and not the markets. It's a game where you're going to automate systems and build the discipline for you using those systems. And then finally, it's a game where you do this diversified strategy repeatedly, consistently over a long period of time. This video series is a 3-part video. The next video is showing up on the screen. I highly recommend to watch that to continue your journey in the financial trade-off.